More than ever have I seen people put in an offer, tie up the property, go do their inspection, walk away.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined, as always, by David Warren. We're both level 2 mortgage agents, and Dave is the owner at Referral Mortgages. And we're here to talk to you about real estate. We want to give a quick shout out to our amazing sponsors: Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, CENTUM, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP, and you can get 20% off each and every order. Dave, how are you?
I'm doing well.
Great. When we first announced the partnership with Easy Neon Signs, we also let people know that there was going to be a giveaway. Okay, you can, as a listener, you can win your own neon sign, like this beautiful sign behind me here. So we did the draw, first giveaway. Thank you for everyone who entered. The winner was Mark. That's how he wanted to be announced on air. Just Mark with a C. Mark with a C. Congratulations! I connected him with Uzo. It's in motion. And anyone else interested, we're going to do these quarterly. So if you're interested, go into the description. There's a link there. You can fill out the form. Super easy. It's free. Get in there. You can win your own neon sign. David, what's going on? How's the week? What's shaking in the market? Talk to me.
Week's going well. I mean, we're only Tuesday. It feels like Thursday. Feels like tomorrow should be Friday already. No, things are going well. In the market, we big news yesterday. We had the budget passed through Parliament, vote of 170 to 168. So that big budget we were talking about moving forward. So we'll be interesting to see and get on as a guest some experts to speak about it in the coming episodes that are more informed than we are when it comes to budgets and how it's going to actually shake up our economy.
Yeah, if you want to get people talking, just bring up anything that has to do with politics or federal budgets, because it seems that a lot of people had a lot to say in our shorts from last week, where we were basically just, it's funny when you get little 30-second sound bites of us going off about certain aspects of the budget. People are very opinionated, which is always nice. So if you're looking for a good time, if you're bored on your lunch break, go to TikTok or YouTube and just scroll through some of the comments on the videos. But yeah, no, I actually saw a stat yesterday. It said by 2030, the GST and HST that the government collects will no longer cover the interest on the debt that we have. So that's interesting. So we'll see how that pans out.
63 billion in GST that we collect, and the interest will be 72 billion. What I believe was the figure, which obviously.
So I'm not saying it's a bad thing. I'm interested to know how we're going to get out of it.
Where's that $9 billion delta coming from?
Yeah, I just want to know what the solution is. Okay, sounds like there's a lot of proposals.
Something tells me our taxes might be going up.
Speaking of going up, Canadian home sales. I actually have the numbers. This was by the Financial Post. So it basically reported from the Canadian Real Estate Association data from October 2024, showing modest month-over-month gains in home sales and prices, though both remain down year over year. So this reflects a slow rebound from economic pressures earlier in 2025, including trade war shocks fueled by ongoing housing shortages and population growth. So this is nationwide October 2025 home sale total numbers, so 42,068 units. So that was up 0.9% from September and down 4.3% year over year from 2024. National average sale price, 690,000. So Ottawa's pretty much right in that median. Like I think we were 696 or something last month. So right in there. So that was up, 690,000 was up 0.2%. From the month previous and down 1.1% from 2024. New listings, this was interesting, actually down month over month, but new listings 80,000 across the country, and months of inventory 4.4 months. So, I mean, Ottawa is pretty much right in there. We went over all the Ottawa numbers in depth last week. So if anyone's listening to this, you didn't hear last week, go back. We did like a full in-depth breakdown of October numbers for Ottawa, but we were pretty much on par. Like I think our average sales price was pretty much exactly the same, maybe 3,000, 4,000 off. And months of inventory, I think we were sitting around 4 months. So, I mean, we're right in the national average, which is kind of expected. Ottawa's kind of that big small town where, you know, Vancouver and Toronto kind of take all the headlines. Montreal's in there, Calgary, all these kind of major urban areas that have all these high prices. And then Ottawa is kind of right in the middle where we're, you know, insulated. We pretty much are exactly on par with the national average, which is very interesting, I found.
Yeah, so they said that the increase in month-over-month activity was led by sales boosted in BC, Alberta, and Quebec, where sales dipped in Ontario, Saskatchewan, and Manitoba, was what TD economists indicated from the CREA numbers. So obviously, you know, kind of the different markets, obviously shifting. We've kind of maintained, like we talked about last week, like you just said, kind of maintain that status, kind of, you know, kind of even keel, if you will, like we kind of usually do. And obviously, Toronto being down, that'll drive the rest of the Ontario numbers.
Yeah. And the market still, I think clients kind of feel like the market is volatile. At least the conversations I'm having, it seems as though buyers do see opportunities. Like I think they're realizing that there's a lot of listings. There's a lot of opportunity out there for them to find something they love. But I think the volatility is also, it kind of creates uncertainty. And I think the headlines we see often contradict reality, which then creates confusion, which then creates hesitation. So I think there's kind of this like ripple effect that's happening throughout the market. I think the headline of the Bank of Canada rate announcement, like we talk about this all the time, but anytime there's a rate drop for the next month, we're basically re-explaining to clients, realtors, partners, etc., like that this doesn't impact fixed rates, that this isn't going to impact them specifically, that this doesn't necessarily XYZ, right? There's all these things. So I think people see the headlines good and bad and just kind of jump to conclusions. And I think that uncertainty, that volatility is really impacting the market substantially right now. I think we will see a strong spring market. That's kind of my opinion. I know we said every year everyone's going to suggest we're pumping the market here, but I think just with the way that things are going right now, I think everyone is kind of, the budget now is settled. It's happening. You know, the rate cut in December is still up in the air, but, you know, we just had one. So, I mean, I think there's more positive sentiment now than there was, say, you know, 3 to 6 months ago. But I think there's still a lot of uncertainty, still a lot of volatility. And I think people are still waiting to see what happens. And I think sellers will probably see, we talked about this last week or 2 weeks ago, we'll probably see some of those listings. We're seeing a high number of listings right now. We'll probably see some of those listings come off the market come December. Nobody really wants to have their home listed over the holidays, most people at least. And we'll see them come back up probably, you know, late January, early February. So that's when I see the market kind of starting to pick up again more aggressively, is in that kind of late January to February timeframe. And I think within that, where rates go is another wild card that could really impact the market, because I'm hearing now bonds have creeped up. I know in the US, the treasuries have gone up. So there's a lot of things that are increasing, which would typically indicate that fixed rates are actually going to climb. So what do you think, Dave? Like, what are you seeing, and what do you kind of see happening over the next, say, 2-3 months over this winter timeframe, as far as, you know, what are you seeing from your buyers, your sellers, and from your realtor partners? What are you hearing, I should say?
I mean, those that are, like, a lot of the people buying are first-time home buyers, not that I'm speaking to, not a lot of resell, like, you know, buying their second or third home. But I have started having a little bit of a resurgence of investor clients calling me, looking at the market, asking me where, you know, talking about, you know, what product and looking at getting in, because they see it as being a good buying opportunity, being that it's more on the buyer side. They believe like that prices are likely kind of nearing the bottom, especially with where rates are at. Most economists indicating that, you know, we're going to maybe see another 1-2 drops potentially next year, over the next year. You know, Scotiabank yesterday came out, though, their economist came out yesterday saying that they don't believe there will be even a drop in 2026 to bank prime or from the overnight lending rate. And to your point about the bonds kind of, you know, ticking up lately and kind of having that upward pressure a bit, that we might actually see some fixed rates bounce back above 4 again. So anyone listening that's up for renewal or thinking about or delaying that conversation, lock in that rate now. But a lot of the buyers, a lot of these investor clients are seeing that, you know, they think that the condo market is kind of nearing that bottom, that, you know, and they're rebuying back into the downtown market. They're buying some of the areas where that product is, you know, there's a lot of leeway. Like, they've got the negotiating powers on that buyer side, and they kind of are buying it for a long-term vision. So I've been seeing that. I think what'll be interesting is really kind of, you know, that the US is finally the government's back. They finally voted. You know, they were at a pause for over a month, and the US government shut down, which
Mhm.
paused most all statistics coming out of the US like statistics bureau. So now we're going to start seeing some of those numbers come in. So this week we've got non-farm payroll data coming out on Thursday, jobless claims on Thursday. So some of those numbers are really going to have an impact as far as where the market goes, and then as well where the U.S. Treasury makes that decisions. You know, we've got a meeting December 10th is an announcement for the Bank of Canada. It's a 90% odds that the market is building in that there's not going to be any change.
Mhm.
And the U.S. Federal Reserve is meeting on the same day, December 10th, and it's a little closer to split, but
Yeah, I think it
no
was
change.
50-50 when I looked yesterday.
Yeah, so
50%.
it's 61% right now,
Okay.
39 as of this morning, 39% for a yes, a quarter point cut. So 39 yes, 61% no in the US. I think some of this data on Thursday will drive a lot of that. And now that they're starting to get some data coming out, or they will start getting some data coming out. So that will have a big indication, like you said, over Christmas, people will take a pause. Stuff will come off the market. It'll skew the numbers a bit for
Mhm.
like in number of days on market or inventory on the market. The people buying will be ones that need to sell and are desperate to sell because they're moving out of town, whatever may be out of country. And those buying will be like, you'll get that buyer market where they'll be pressing, but that'll obviously skew the December numbers and then back later in January, like you said.
Yeah, and we always joke about it. We always get Christmas Eve, we always get that APS or whatever. There's always some people that are shopping. And if you're a buyer, honestly, I think it's a very good time. I know I'm kind of
Mhm.
beating this to death here, but the last few homes I bought have been in like basically from December 15th to January 15th. Like that's when I put the offer in because there's not as many people out shopping. Sellers typically, if they're listed during that time, are a lot more open to kind of that conversation. I had a client this week that was asking me, we were talking about kind of the volatility in the market and prices and so on. And they had actually listened to the show and heard that the average home price had been dropping. And they were asking me how this shifts the bank's view of things. Like how do they, like, does it trigger more appraisals? Does it, what impact does it have on the lending side? And so tomorrow I'm actually doing a presentation called Volatility to Value for a group of
Mm.
realtors. But I actually put together kind of how it impacts buyer behavior and how it impacts the bank or like kind of lender behavior. So very quickly, like from a buyer behavior, and I kind of touched on this earlier, but hesitation increases. So whenever there's uncertainty or volatility, it makes them like they hesitate more, which means longer decision cycles, which means, typically more days on market, longer sales cycle, that sort of thing. The fear of overpaying tends to override long-term thinking. So I know we've talked about this in the past, maybe a while ago, but they are fearful that they're going to pay, 10,000 more than they could have got it in a week from now or something. When, you look over the next 25, 30 years, that $10,000 is completely extremely nominal over the long term. So kind of that fear of paying more than they need to or not getting that bottom tends to override long-term thinking. Pre-approval expiry becomes a bigger risk during rate swings. So right now, like as rates start to go up, if we have someone pre-approved and we have a rate hold at 399, let's say, and that expires December 15th, and now rates are going back up to 4.25, like that's going to impact that person's qualifying, right, their eligibility. So that's kind of on the buyer side.
Sorry, sorry to cut you off because I want to touch on something there that you mentioned
Yeah.
that a lot of people, they're not aware when there's a rate hold. Can be held for 120 days. Like you mentioned, it might be up at December 15th. They have to be closing by that date. The rate is going to be up and gone by that date. So kind of keeping that in mind as a buyer. Sorry,
Yeah,
I'll let you go
no, it's
back.
a very good point. It's a very good point because people don't. They're like, "Oh, we're locked until December 15th," like I said. So, oh, we got our APS in December 10th. It's like, well, hopefully you close this week.
Yeah, got to
But
close
yeah, no, but I
tomorrow.
mean that's on us too, right? That's on the
Yeah.
agent and the advisor to make sure that they're fully aware of that. But that's kind of, it does create in a lowering rate environment. Doesn't matter because you get that approval, you can just
Mhm.
drop it down. But in an increasing rate like this, where we're thinking that rates may go up, very important to know what that kind of expiry is on that pre-approval. On the bank lender side, so things to consider on that side, tighter risk assessments. So they look a lot more, they're a lot more diligent on income verification. I've seen some lenders that will want letter of employment, pay stub, T4s, T1s. They're doing verbals, they're calling the employer, they're emailing the employer, like they're doing their due diligence, right? They want to make sure that they're not getting into something where they aren't able to get out of it. So they're a lot a lot tighter risk assessments, more conservative appraisals. So we talked about this last week, how when values are declining or even just coming down slightly, it's going to trigger more appraisals just because that automated valuation model is not going to assess the value at what they might have paid for it. If there's, a recent sale on the street or something that happened that was at a lower price point, that AVM is not going to happen. So it kind of triggers more appraisals, more document scrutiny, so longer approval times. So I have seen that, like kind of, usually where it's a 24-hour turnaround, you might have 2, 3, 4 days now for turnarounds. And some lenders reduce certain products or change rate policies quickly. So, we've seen this where you have a file that client sends you an APS today, they have an offer closing in February, and, you're missing a couple documents, you're kind of putting it together, and then lender, sends a note at 11 p.m., hey, rates are going up at midnight. You're like, okay, so quick changes that we aren't really aware of, and that's why it's important to get things locked in as soon as you can. And just a reminder too, I know we've mentioned this, but if you have a rate and rates decrease, like we can always request, with most lenders, we can request what's called a float down, so we can actually have them lower the rate from the rate you are locked in at to whatever the lowest rate is between now and your closing date, usually within as a 10 business day buffer usually before closing. But if rates, if you're not locked in and rates go up, like there's nothing we can do, right? If your rate is locked, you're approved, and rates go up, you're safe. And if they go down, you can get the lower. But if you're not locked in, if we haven't submitted that file yet and it's not locked in and rates go up, like there's nothing we can do. Like it is what it is. Rates change every day. And especially as mortgage agents, mortgage brokers, we have, 40 plus different lenders. They all have different rates. They all have a matrix of rates. I have to kind of explain this to clients where, let's just say TD, for example, TD sends us a rate sheet and there's 50 different rates on it, depending on, is it a rental? Is it owner occupied? Is it a flex line? Is it a mortgage? Is it a variable? Is it fixed? Is it, there's like
25 or 30 year. What's the loan amount? What's the credit score?
Yeah. There's literally, they call it a matrix, like a rate matrix, because it's like a full web of rates. So you multiply that by 40. Like we have a very wide range of rates, and they all change constantly. So it's, it's on us to do, obviously be on top of that, but just for clients and realtors, if you're listening to this, like when your clients have an accepted offer, get that file in and approved as soon as possible.
Are you trying to grow your mortgage business? CENTUM has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with CENTUM. Learn more at CENTUM.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Guertin, Poirier, Avocates lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at guertinpoirierlaw.ca. Let's get to the heart of your deal. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
The other thing we're seeing now, not to go off on a bit of a tangent here, but conditions. When we're in a market like this, way more conditions being put in, which I think is great. Obviously, if you're a buyer, like it protects the buyer. But more than ever, have I seen people put in an offer, tie up the property, go do their inspection, walk away. Like it's almost like people are wanting to buy homes. These clients are very excited. They want to get into the home. They find it. They're super motivated. And then they do the inspection and it's like all the magic dust is gone. It's like, oh yeah. No. We pulled the curtain back and we saw how it was working. We're not interested anymore. So I've seen a lot of people that have put in offers and then walked away because of that condition. But that's what I mean. Like being able to have that conditional period is so important. And in these times, I'm seeing in some cases like 5-10 day conditional periods, it's great as an agent because it gives us time to do what we need to do. There's nothing worse than getting an offer on a Monday and conditions are up Wednesday. You're like, okay, guess I'll call some favors in. Let's get this done. And we always do, obviously. But the more time, the better, you know?
No, absolutely. And I mean, and really to that point of rates and you know, we obviously talk about that being mortgage agents and kind of, you know, but looking at the macroeconomics of what's going on in the country, like we talked about, how the budget impacts things, how even yesterday, you know, and you know, kind of to try and to look to transition as well to something that was important yesterday was the CPI and inflationary numbers that came out in Canada. We had headline numbers that eased to 2.2 year over year, and down from 2.4 in September. This, you know, it's on the surface, it looked friendly, but it's kind of looking at the underlying numbers. So we were seeing that tick up as far as the underlying metrics. And so kind of, you know, looking at not just the headlines, but also kind of looking deeper under the hood to kind of get an idea and a sense of where things might be going. And this is where, you know, what we talked about of, you know, that upward pressure on rates, this is what some of this is kind of driving towards. So, you know, really homeowner and mortgage insurance was up 6.8% year over year. Rent inflation accelerated to 5.2% from 4.8. Property taxes priced annually each October rose 5.6%. Vehicle insurance, so auto insurance, climbed 7.3%. And sell mobile phones. Like, who would have thought we'd continue to see this increasing? It's ridiculous.
Can they go higher?
The most expensive, I know, posted their first annual increase in more than 2 years. So they kind of held steady over that period of time. So kind of looking at those underlying metrics of what's actually driving things kind of gives you an idea of where things might go, where they might be from the Bank of Canada. So kind of watching that through the year, and as you're looking at your upcoming renewal, or you're a buyer, or you're a realtor, you know, keeping it like abreast of what's going on in the economy is not only important as Canadians, you know, within like just regardless of real estate, regardless of mortgage rates, but just in general, it's important to kind of keep in tune with that. But especially if you're in the market where interest rates drive the market, if you're a realtor, in most cases, or a mortgage agent, for a buyer or a seller, that also drives the market. But there's early indicators as well. And so some of these, like we're talking about, are early indicators of what's maybe happening in the market and what you can kind of see ahead of time as potentially being issues down the line or good signs. And so just being aware of that.
So Dave, I know you are an aficionado, okay, when it comes to government, to budgets, okay? You're in the know. So I would like, just to set the record straight, can you tell our listeners in just very simple, easy to understand language, how these federal budgets increase the cost of living for all Canadians?
Any expenditures by the government that are not going to increase productivity and GDP within the country, if it's not going to direct investment and it's going outside of the country, so a lot of the big projects, like the LNG project, for example, a lot of the expenditures with that LNG pipeline project that it's under the major projects division, most of that infrastructure is using foreign steel, foreign parts, and foreign development. It's not investing within the country. That's inflationary. We're not investing within the country in that regard. So no matter what, if we're spending money that is not boosting the economy and boosting, you know, tax revenue or revenue in general, exports, things like that, then it's going to drive inflation. Printing money is going to drive inflation. This is printing money. We are hopeful. It's actually a $130 billion budget. All the headlines always say $78 billion right now. It's actually a $130 billion budget with the hopes that there will be a $62 billion cut in expenses. That's to be seen. At the end of the day, the budget is out for $130 billion in expenditures. That's without any other outliers, any other influences that might drive that up. And we're hopeful that there's going to be projected cuts. So all of that is just printing money back into the economy, and that's going to raise prices because there's more money supply into the market.
Thank you. That's perfect. And if anyone's listening, like, we are obviously not economists, but we both have open minds. So if you hear this and you think Dave doesn't know what he's talking about, these guys are out to lunch, like, please explain in detail exactly how we aren't understanding this and what the bigger picture is, because I'd be very interested to know, because it seems on the surface obvious what we're saying, but there's kind of kickback. So I'm, open-minded, love to hear the other sid of the story. No matter how flat the pancake, there's two sides, but
if you go to TikTok and read, I think it was TikTok with all the 3-word comments, which were hysterical, no explanation of anything. But yeah, I mean, overall, it drives debt. It drives, like we talked about at the beginning of the show as well. Like when you look at the cost of the budget and where our debt will be if everything gets spent that's in this budget, and that's what that and the cost savings are there. So let's say there is that 62 billion in cost savings. So it is that 78 billion. Again, our interest on that debt is going to be in excess of what our entire GST is brought in. People that don't recognize that as being a problem, I just don't understand how they are not seeing that as an issue, because there needs to be the revenue there to service that debt. The same being as a personal, if you look at your own budget, you're bringing in $1,000 in income net a month, and your expenditures are $1,300. You're racking up a credit card bill. You're going to have issues with your own credit score. You're going to have issues and need to go into, a consumer proposal or a bankruptcy. Obviously, we're talking about the government. It's a different story, but it's the same analogy of if you're in excess of what you're bringing in income, and you're in excess of that, you're running it up on a credit card and you're continually paying high interest on it, and you can't service that debt, you're going to run into problems at some point.
Yes, and that's exactly what's happening as well. And I think that's the fear, is that at least with a human being, whoever the bank is eventually like, okay, 30K is plenty. Like you've maxed out. We're not giving you any more. This is the end of the line. You need to change something in your behaviors, But that doesn't happen when it comes to these basically to the national economy, because they can just create more of the money that they need, which then devalues it, which then creates increased cost of living for everyone. So that is kind of
increases taxes increases taxes, which, you're either increasing income taxes on individuals, and it doesn't matter whether we're talking about low, medium, high income earners, whether we're talking about corporations or whether we're talking about GST and federal taxes of consumer spending. The revenue needs to come from somewhere. So the same analogy for personally, if you're running a deficit of $300 a month because you're making $1,000, your expenses are $1,300, you need to make more in order to break even. So it's the same idea on the federal level. There needs to be an increase in revenue somewhere, or you're cutting those expenses. But as we see through all governments, it's been a long time since there's been a balanced budget or a surplus. We keep running deficits. So we're not cutting our expenses enough, and we're just running a continual deficit, which at some point there's going to be problems.
Some point. Should we slide into some mood boost, David? Now that we've
let's do that.
Now that we've ruined everyone's day with some facts,
I'll stay away.
Okay,
I can't even get on TikTok. I'm not even on it, so I don't have to worry about reading any of the comments after that.
Here we go. We got 3 today. Number 1, why couldn't the sesame seed leave the casino? He was on a roll. Sesame seed was on a roll. Number 2, don't worry if you missed what.
He was on a heater.
He was on a heater. And you know what they say? Okay, number 2, don't worry if you miss a gym session. Everything will work out. Yeah. Number 3, can I tell you a cat joke? Just kitten. Just kitten. Ooh, that was a bad one. Thank you, everyone, for tuning in. Thank you for listening. And like I said, if you haven't already, follow us on our socials. Always some great banter, some great conversations on there. And thank you again to our sponsors, Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, CENTUM, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP. Get 20% off each and every order. Thank you, David. Thank you for showing up. Thank you for being here. See you soon.
Deuces.
Bye, everyone.